Imagine waking up tomorrow and the stock market is down 10%. Trillions of dollars wiped out in days. Your 401k, your portfolio, your retirement, gone. Not slowly, overnight. This isn't a random prediction from some anonymous account on social media. This warning is coming from one of the most powerful financial institutions on the planet, JPMorgan Chase, a bank that manages nearly $4 trillion in assets. And the reason behind the warning is something investors around the world are watching very closely right now. Rising geopolitical tensions, surging oil prices, and a fragile global economy. The market's own fear gauge, the VIX, just hit 31. And Jamie Dimon, the CEO of JPMorgan, just compared today's markets to 2005, 2006, 2007. The 3 years of calm, right before the worst financial collapse in a century. But here's the question nobody on Wall Street wants to answer out loud. If stocks fall 10%, what happens to Bitcoin? Does it crash with the market? Does it crash harder? Or does it finally become the one asset everyone runs to when the system they trusted starts to break? Because history shows something strange, something that keeps repeating. Every single time a financial shock hits, every major crisis tests what Bitcoin really is, a speculative bet that falls apart under pressure. Or the alternative financial system it was designed to be from the very beginning. We don't have that answer yet. But the next few weeks might give it to us. And if you're not paying attention right now, you might miss the most important signal Bitcoin has ever sent. Stay with me, because in this video, we are going to walk through what is really happening in the markets right now, why today specifically matters, and the 3 scenarios for Bitcoin that every investor needs to understand before the next move happens. And I promise, stay with me until the 10 to 12 minute mark, because what I reveal about the relationship between financial crises and Bitcoin cycles will completely change how you understand this market. Most investors never see this pattern until it is too late, and when they finally do, they cannot unsee it. If you are new here, welcome to the Wealth Continuum, where we break down the macro forces shaping your financial future. Hit subscribe so you never miss a moment like this one. Now, let's get into it. Let me give you the full picture of what is happening right now, because the headlines are only telling you half the story. On February 24th, 2026, Jamie Dimon sat in front of investors at JPMorgan's annual Investor Day and said something extraordinary. He looked at record stock prices, AI-driven euphoria in the market, banks making increasingly risky loans, and he said, and I am paraphrasing here, that it reminds him of 2005 and 2006 and 2007. The rising tide lifting all boats, everyone making money, people leveraging to the hilt. The sky was the limit. And then came 2008. Now think about what is already happening on this very day. March 10th, 2026. Oil is at $101 a barrel. That is not a typo. Up 11% today alone, driven by a sudden escalation in geopolitical tensions in the Middle East. That kind of single-day move in oil is historically rare. The last time we saw a spike like this, it sent shockwaves through inflation data for months. The VIX, which is Wall Street's real-time measure of fear, just hit 31. For context, anything above 20 is elevated. Anything above 30 means the market is genuinely scared. And in February, the United States economy unexpectedly shed 92,000 jobs. 92,000 jobs gone in a single month. That is not the picture of an economy in perfect health. Now, layer on top of this, the S&P 500 is trading at a forward price to earnings ratio of roughly 22. The 30-year historical average is about 17. That gap matters. It means stocks are priced for near perfection at the exact moment the world is becoming anything but perfect. JPMorgan, our own analysts, have identified 4 medium-term risks to global markets right now. An AI earnings bubble waiting to burst, power generation constraints limiting tech growth, China potentially closing the semiconductor gap, and rising geopolitical risk around Taiwan. Any one of those alone could shake markets. All 4 together, that is the kind of confluence Jamie Dimon is losing sleep over. Quick question, where are you watching this from and what time is it there right now? Drop it in the comments. I read every single one. Here's why today's oil spike matters so much and why you need to understand it before we even get to Bitcoin. When oil prices rise sharply and quickly, it is not just a problem at the gas pump. It spreads through the entire economy like a pressure wave. Transportation costs rise. That means goods cost more to move from factories to warehouses to stores. Manufacturing costs rise, food prices rise, Airline ticket prices rise, heating bills rise, and here is the dangerous part. All of that feeds directly into inflation. Right now, inflation in the United States has been sticky. It refuses to fall cleanly to the Federal Reserve's 2% target. The Fed has been cautious about cutting interest rates for precisely this reason. But here is the trap. If oil spikes and inflation comes back, and at the same time the economy is losing jobs and growth is slowing, you end up in what economists call stagflation. Stagflation. The toxic combination of stagnant economic growth and rising prices simultaneously. This was the nightmare of the 1970s. It was devastating for stock markets. It eroded the purchasing power of regular people. It forced the Federal Reserve into painful decisions. And here's what I want you to sit with for a moment. The United States is carrying over $36 trillion in national debt right now. $36 trillion. That is a number so large, it is almost impossible to comprehend. If you spent $1 million every single day from the birth of Christ to today, you still would not have spent $36 trillion. When you combine that level of debt with rising inflation, slowing growth, and geopolitical instability, you have the ingredients for something far more serious than a standard market correction. And this is exactly the moment Bitcoin becomes the most interesting asset on the planet. Is it sunny, raining, or freezing where you're watching from? Let me know below. And while you're down there, tell me, are you bullish or bearish on Bitcoin right now? Before we talk about what could happen, let me give you an honest picture of where Bitcoin actually is right now. As of this morning, March 10th, 2026, Bitcoin is trading at approximately $70,000. Now that might sound fine on the surface, but here is the context that changes everything. On October 6th, 2025, Bitcoin hit its all-time high of $126,210. That means right now, Bitcoin is sitting roughly 46% below its all-time high. Nearly half of its peak value wiped out in 5 months. Year to date in 2026, Bitcoin is already down around 23%. The total cryptocurrency market cap has fallen from over $3 trillion at its peak to around $2.3 trillion today. Now, let me give you a number that should make you think. JPMorgan's own analysts recently estimated Bitcoin's production cost, the average cost for miners to produce one Bitcoin, at approximately $77,000. Bitcoin is currently trading below that production cost. That matters enormously. When an asset trades below its cost of production for an extended period, one of two things happens. Either the producers, in Bitcoin's case, the miners, start shutting down operations, which reduces supply and can eventually support price recovery, or the market continues to fall and we enter a deeper pain cycle. Here's the other side of that coin. Institutional inflows into Bitcoin ETFs just hit $155 million in a single month, March 2026. MicroStrategy purchased over 3,000 Bitcoin just days ago for $204 million. Morgan Stanley recently filed for a national trust bank charter specifically to custody Bitcoin. The Federal Reserve's payment system just opened access to the crypto industry for the first time ever. On March 5th, 2026, the institutions are still buying. So we have a fascinating collision of forces. Macro fear pushing Bitcoin lower, institutional adoption pulling it higher. And sitting in the middle of all of that, an oil shock, a terrified VIX, and a very worried CEO at the world's most powerful bank. If you are still watching at this point, drop a BTC in the comments. I want to know who is in this with me, because what comes next in this video is the part most people skip, and it is the most important part. This is the question that has followed Bitcoin for its entire existence, and we still do not have a definitive answer. But what we do have is data, and the data tells a complicated, fascinating story. During the COVID crash of March 2020, Bitcoin fell nearly 50% in a matter of days. Investors panic sold everything, stocks, gold, and Bitcoin. All of it went down together. In that moment, Bitcoin looked exactly like a high-risk speculative asset. But then, something happened that most people did not see coming. Bitcoin recovered faster than almost anything else in the market. Within months, it entered one of the most explosive bull runs in financial history, going from around $5,000 to nearly $65,000 in under a year. The pattern repeated. In 2022, when the Fed started aggressively hiking rates and crushed risk assets globally, Bitcoin fell from $68,000 all the way to $15,000. It behaved like a leveraged tech bet, highly correlated to NASDAQ, deeply sensitive to liquidity conditions. But then, Again, it recovered. And by October 2025, it had hit a new all-time high of $126,000. So what does the pattern actually tell us? It tells us that Bitcoin has two faces in a crisis. The short-term face looks like panic. When markets sell off rapidly, Bitcoin often sells off too, sometimes harder. Institutional traders and hedge funds use Bitcoin as a liquid asset they can sell quickly to meet margin calls elsewhere. That creates a temporary correlation with stocks. But the medium to long-term face looks very different. When the crisis stabilizes and central banks respond with liquidity, rate cuts, stimulus, money printing, Bitcoin has historically been one of the first and fastest assets to recover. And here is the deeper reason why. Bitcoin's supply is fixed forever. There will only ever be 21 million Bitcoin in existence. No government can create more. No central bank can dilute it. No politician can vote to print more of it. When confidence in traditional financial systems weakens, and when central banks respond to crises by expanding their balance sheets, the fixed supply argument for Bitcoin becomes more powerful, not less. Right now, JPMorgan's own analysts are still bullish on crypto for 2026. They said, and I quote the direction of their thinking here, that they expect institutional inflows to continue rising and that regulatory clarity is supporting the digital asset market. This is the same bank whose CEO just warned about a financial cycle turning. Bullish on the structure, cautious about the macro. That tension is exactly what makes this moment so unique. Let me know in the comments. Do you think Bitcoin is a risk asset or digital gold? I genuinely want to know what you think. Now let us get specific. Let me walk you through 3 realistic scenarios for Bitcoin if global equity markets sell off 10 to 15% from here. And I want you to think carefully about each one, because your answer to which scenario you believe will determine how you should be positioning yourself right now. Scenario 1, Bitcoin crashes with the market. If a broad equity sell-off happens, triggered by the oil shock, a deteriorating jobs market, or a geopolitical escalation, institutional traders will sell liquid assets first. Bitcoin is one of the most liquid assets on the planet. It trades 24 hours a day, 7 days a week, 365 days a year. In a panic, that liquidity makes Bitcoin an easy target. We have already seen Bitcoin's short-term correlation with the NASDAQ at 85.4% over the past 7 days. In a rapid sell-off, that correlation could tighten further, pushing Bitcoin down to the $60,000 to $63,000 range. And if support fails there, possibly toward the $59,000 level that technical analysts are watching right now. This is the scenario most people fear. And in the short term, history suggests it is entirely possible. Scenario 2, Bitcoin dips, then rebounds aggressively. This is the pattern we have seen more times than any other. An initial panic phase pulls Bitcoin down. Fear peaks. Weak hands sell. Then, as the dust settles, capital starts looking for the fastest path to recovery. Bitcoin's limited supply means that when demand returns, price moves fast and hard. The rebound in 2020 took Bitcoin from 5,000 to 65,000 in less than a year. If this scenario plays out, the dip might be the opportunity. The question is whether you have the stomach to hold or accumulate or through the fear. Scenario 3, Bitcoin decouples and becomes the macro hedge. This is the most controversial scenario, and it is the one that could change how the entire financial world views Bitcoin forever. In this scenario, as geopolitical tensions escalate, as debt levels become unsustainable, as inflation returns and erodes purchasing power, a meaningful portion of global capital begins moving out of the traditional financial system and into assets that exist outside of it. Gold has historically played this role, and gold is trading above $5,000 right now, up over 1,000% from its lows a decade ago. Bitcoin is in many ways digital gold with harder scarcity, fixed supply, decentralized, borderless, and increasingly held by institutions, corporations, and sovereign wealth funds. If scenario 3 begins to emerge, if Bitcoin starts rising while stocks fall, that would be a seismic shift in how the asset is perceived. Not just for this cycle, for decades. We are not there yet, but the conditions for it are building. Tell me in the comments, which of these 3 scenarios do you believe is most likely? And are you watching this during work, on your lunch break, or late at night when you should probably be sleeping? Here's what I want to leave you with. And I want you to think about this carefully. Every single previous financial crisis in history happened in a world without Bitcoin. The crash of 1929, The oil shock of 1973, the Asian financial crisis of 1997, the dot-com collapse of 2000, the global financial crisis of 2008. None of those crises had to answer the question, what happens to the new decentralized alternative to the financial system when the old system comes under severe stress? Now we are entering a period where that question may actually get answered. We have record national debt of over $36 trillion. We have an oil shock unfolding in real time today. We have a VIX above 30. We have a legendary banker comparing the current market to the years before the worst financial collapse in modern history. And we have Bitcoin, an asset that did not exist during any of those crises, now sitting with a $1.3 trillion market cap held by major corporations, offered in ETFs by the world's largest asset managers, and with the Federal Reserve's own payment infrastructure now open to the crypto industry. Bitcoin has never been tested in a full-scale macro crisis involving all of these forces simultaneously. Not an oil shock alone, not a debt crisis alone, not geopolitical instability alone, all of them together. The result of this test, however it plays out, will shape how investors, institutions, and governments view Bitcoin for the next 20 years. And you are watching it happen in real time. That is not a reason for panic. That is a reason to be paying extremely close attention. Right now, the warning from Jamie Dimon is not a guarantee that a crash will happen. Markets are resilient. They surprise people constantly. The same analysts who predicted doom in 2025 watched the S&P 500 post double-digit gains 3 years in a row. But the warning is a reminder that certainty in markets is always temporary, and uncertainty is where the most important financial decisions get made. Here on the Wealth Continuum, this is what we do. We track the macro forces that most people are too busy, too distracted, or too comfortable to pay attention to. And we try to give you the clearest possible picture of what those forces mean for your financial future. Not with hype, and not with fear, but with as much clarity and data as we can bring to you. If this video gave you something to think about, something you had not considered before, then you are exactly the kind of person this channel exists for. Subscribe, turn on notifications, because the next few months in the markets are going to require you to think carefully. And I want to be here with you when they unfold. And before you go, I have one question for you. If global markets fall sharply in the coming weeks or months, do you believe Bitcoin will fall with them? Or do you think this could finally be the moment Bitcoin starts behaving like the digital gold it was designed to be? Drop your answer in the comments. And if you made it all the way to the end of this video, I genuinely appreciate your time and attention. Not many people have the patience to think this carefully about their financial future. That patience is exactly what separates the people who build wealth from the ones who only watch it happen to others. See you in the next one.